Greetings and thank you for checking out Keystone TV. The fact that you're watching this video shows that you care about your financial future and you want to improve your situation. What I want to talk about today is what happens when we chase yield and how destructive it can be to chase yield. Let's look at one of the most volatile periods of time in the stock market that we've ever seen, 2006 through the end of 2009. And I'm going to compare a CD buyer with someone just invested in the Dow Jones, 30 large US stocks. Now, this is an income investor. This is someone who's looking for income, looking for yield, right? Really looking for income, so they're chasing yield in our example. So investor A goes out and buys a CD. That CD in 2006 was paying over 5%. Now, we know what happened over the time period from 2006 through the end of 2009. By the end of 2009, that same one-year CD was paying under 1%, only 0.9% interest. Now, let's suppose investor B, was invested in the stock market, in the Dow Jones. Well, that was paying dividends as well. The Dow Jones in 2006, the dividends were about 2.3%. By the end of 2009, they were up to about 3.5%. Well, we want to look at the principal, right? Because the CD buyer had guarantee of principal that whole time. But before we go look at that, let's just look at the income component. So the CD buyer on $100,000 during that 4-year period earned a little over $12,000 in interest. The stock buyer that was invested in the Dow just through the dividends there ended up getting just under $11,000. So the CD buyer came out ahead, but not by much. And one of the things that's worth noting is that although in 2006, which is why the person bought the CD, because they were chasing yield, it was 2.3 times higher than what the yield was that they could get just through the dividends in the Dow. But by the end of 2009, the Dow dividends were paying over 4 times as much as that same CD buyer was getting in interest on their CDs. So it was a much better investment from that perspective moving forward. But the principal, you ask, you say, well, the volatility was extreme with the stock market and the CD buyer had guarantee of principal. You probably think you know what happened, but you may not actually know what happened. The Dow Jones from the start of 2006 to the end of 2009, yes, there was volatility, but who cares? Our investor is an income buyer. They were looking for income. By the end of 2009, the principal investment was virtually the same as what it was at the start of 2006. And moving forward, that investor was getting 4 times as much income by the end of 2009. So what's the end result? If you chase yield, you get what you deserve. Hopefully this added some perspective on CDs versus the stock market and income investing. Thank you for joining me, and I hope you have a great day.